We have a panel discussion, and the chair of that discussion will be Tensie Whelan. Tensie is the director for Stern's Center for Sustainable Business, and she will introduce the panel. Tensie, the floor is yours.
Thank you so much, and I really appreciated the presentation by Dr. Bilio and also the remarks from Allison Heron-Lee, and I look forward to hearing our panel's thoughts on those two interventions. So first, I want to introduce the panel, and then we'll go right into some questions. So we have Annette Nazareth, who is Senior Counsel at Davis, Polk, and Wardwell. She is the operating lead for the Task Force on Scaling Voluntary Carbon Markets. We also have Ilya Khaykin, and Ilya, please feel free to correct me on that.
Khaykin,
thank you. Who is Partner Financial Services at Oliver Wyman, and he heads their climate business. And then we have John Hale, who is Global Head of Sustainability Research at Morningstar. Welcome to all of you. So we heard first from the SEC, and as you know, the SEC recently released a risk alert on ESG investing related to misleading or inadequate disclosures. Among other issues, they found that portfolio management practices were inconsistent with disclosures about ESG approaches. There were inadequate controls to ensure that ESG-related disclosures in marketing were consistent with the firm's practices. Compliance programs did not adequately address relevant ESG issues, et cetera. So from your perspective, as three have been involved in various different aspects of this whole space, what should constitute best practice for investors in ESG disclosure management? This is a large question, so I'm looking forward to hearing our different perspectives. So let's start with you, John.
Okay, well, sure. Well, I wrote about this risk alert a couple of weeks ago, and to me, and said the gist of it really is to wealth managers and asset managers, hey, when it comes to ESG investing, say what you mean and mean what you say. And I think the two big challenges with that are, number one, we just touched on it, what is ESG investing in the first place? I mean, different terminology is often used. At Morningstar, we typically use sustainable investing and define it as investment approaches that seek to deliver competitive financial returns while also driving positive sustainability outcomes or ESG outcomes. But some may define it purely within the context of investment risk and return. Others are more focused on broader impact. I think in general, there's kind of a combination of those factors in terms of underlying preferences. And, I think many financial advisors and wealth managers and maybe even other intermediaries think of this more in terms of aligning portfolios with client values, whatever they may be. And it just so happens that those clients who are concerned with values alignment in this day and age are mostly concerned about sustainability issues and at minimum having a portfolio that sort of does no harm. So anyway, the definition I think is very important in the interaction between end investors and intermediaries. And then the second challenge on the asset management side, I think, is that there are at least a half a dozen or so different approaches that an asset manager may use to implement what it regards as an ESG or sustainable strategy. It's not just limited to interpreting data and ratings. All these approaches can be implemented in more or less comprehensive ways. And any given ESG strategy might employ several different approaches. For example, some might use some exclusions, perhaps fossil fuels. Others may focus on best-in-class ESG performing companies going sector by sector. Many have dedicated ESG engagement programs, but some are more comprehensive than others. So you might have funds that are focused more thematically on companies whose products and services are contributing to the energy transition. And finally, just to bring it back to the more focused topic of the conference, we might have other funds, and we're starting to see that are focused solely on climate risk in company assessments and engagements. So I think, asset managers clearly need to be more transparent about their ESG strategies by clearly delineating their approach or mix of approaches they use and how far they go with each one, and then demonstrating outcomes. And this is typically more information than is usually provided, I think, by investment strategies and funds. So they need to come up to speed on that. And then wealth managers and other intermediaries, just they need to be very clear with their clients about definitions, so they're on the same page, and make sure that the funds or strategies that they're using are actually aligned with the way they depict ESG to their clients. If a client does have very specific criteria surrounding exclusions, they need to make sure that the funds or strategies that they select follow those same criteria. I think it's better for intermediaries to first seek out the funds or strategies that they prefer to use for most of their ESG clients, develop a thorough understanding of how those offerings incorporate ESG, and then make sure clients understand it. Working from the other direction, first coming up with specific sort of customized ESG criteria for clients, and then searching for and trying to monitor appropriate investments can be much more difficult. And, I just think that ESG investing doesn't have to be, you just have all about sort of creating unique customized approaches for every client. And just to finish, I would say, that the risk alert did not say that the field was sort of rife with misinformation and greenwashing, just that they had seen instances of a disconnect between how ESG is described and how an investment process that emphasizes ESG is being carried out.
Thank you so much, John. Annette.
Thank you, and thanks so much for having me here today. I totally agree with John that the headline of that risk alert is, say what you mean and mean what you say. To put it in the context of what's happening, and I think it was wonderful to hear from Commissioner Lee early on. I mean, as you can tell, the SEC is focused on ESG and particularly climate change issues in a number of respects. So as the commissioner said, obviously there's going to be a keen focus on disclosures, and we are really, we're far along in some ways in that we've made a lot of progress with SASB and TCFD, but on the other hand, we don't have mandatory disclosures, and really coming down to issues like what are the definitions of these things? Do we even have, are we speaking even in a common vocabulary is going to be very, very challenging. So I think, while the SEC is talking about disclosure, which you'd accept, they are the sort of primary disclosure agency, they also are very focused on existing practices. So they're not just waiting for rulemaking, which takes a long time. They're saying there are things going on now that we could be looking at. And that, in a sense, is partly the subject of that risk alert, because it was noteworthy that the climate group now within the SEC is sightest in enforcement. I don't think we're looking for regulation through enforcement necessarily. And I think John pointed out that, the SEC, even in the risk alert in the Division of Examinations, didn't say that everybody was engaged in bad practices, but they did sort of cite instances where I think they thought there was greenwashing, and then instances that they thought were more appropriate. And basically what they're saying is, if you're going to be, advertising in a sense that you're, focused on ESG, then you've really got to define what that is, what that means, and you've got to follow through. So you need to have internal policies and procedures that are consistent with what you're saying to the public. You have to, enforce those internally. You should be engaged in proxy practices that are consistent with what you're telling people, you're doing. And you should have, compliance personnel who understand these issues and can oversee them within your organization. So, to me, what this means is that we sort of have an intermediate and long-term focus, but we also have an immediate focus. And these are things that can be addressed immediately. And I think the SEC is very serious about them. They are clearly examining for these issues, both on the asset management side and for corporate issuers that talk about these things. And so it's going to continue to be an area of focus, but also a challenge as again, we're all learning as even the science around this is changing. We are trying to just sort of make sure that we're speaking, as I said, in a common language.
Thank you so much, Annette. And Ilya, looking forward to your thoughts.
Thank you, Tensie. Yeah, no, I share the observations of my colleagues here. I mean, one way I think about it is just kind of taking a step back. I think about, you know, how in 2019 the Business Roundtable released a statement about what is the purpose of a company, and that was very different than the traditional shareholder view, right? And it was more encompassing of other stakeholders, employees, customers, suppliers, communities. And I think now we're evaluating companies, and investors and asset managers are evaluating companies in some respects in a different way, more than a purely, in some cases, more than a purely kind of traditional financial and profit oriented way. And again, there are different definitions of exactly what ESG means. But what we're seeing is the beginning of kind of bringing in these normative considerations in investment decisions. And so, you know, while we have that, and that's what's going on, it is still very new. And so there's sort of two elements to that, I think, that are contributing to what we're seeing. One is, you know, back to what John was saying, that the definitions of how what does ESG mean from your perspective, and how are you defining that? What are the objectives that you're setting out? That is not clear. And so, you know, one area I think that's important is around clarifying that, how asset managers and investors see that issue, and what really the objective is in their minds. And then the second part of it, you know, again, I think Annette touched on this, that there's a kind of a whole policy and compliance and controls infrastructure that hasn't been brought to this in the same way that it has been brought to other types of disclosures, that now we need to start bringing to this issue as well.
Thank you so much. So in sum, I think I'm hearing a consensus that there's really, you know, three elements of this. One is, and we'll talk about this in our next question, around the ESG metrics and ratings. Another is around being clear about what the objectives are. Are you a negative screen? Are you doing ESG integration? If so, towards what? Does it really impact investing, and so on? Because there's different approaches to that, and retail shareholders and institutional shareholders aren't always clear on that. And then that there is this real need for much more of a focus on the process behind the infrastructure behind your management of these issues. So thank you so much for that. Let's move on. So the Bilio paper presented earlier found significant challenges, to say the least, with the ratings used today, with agencies using different definitions of ESG, resulting in different ratings of companies, and through the research that they did, again, because of that dispersion of information, no clear connection between financial performance of the asset managers. So how should this issue be tackled? You know, what is needed to create coherent, consistent definitions and ratings? Dr. Bilio said we need a set of common metrics, given that these companies compete over that issue. Like, how does that work? So would welcome your thoughts. And let me go backwards this time. So Ilya, maybe you can kick us off.
Sure, happy to do that. You know, so I work a lot in with banks and other financial institutions, and so you pay a lot of attention to the types of disclosures in that sector, and I think a lot also, in particular, TCFD disclosures that corporates and financial institutions have been making. And you know, I think part of the question is really around how do we make sure that there's the right type of content in those disclosures, and not just kind of a check the box list, and that those disclosures are meaningful. And I think the initial phases of some of this, right, and particularly thinking about initiatives like TCFD, the initial phases were let's start setting the expectation for disclosure, right? And it's obviously a huge industry, and we're kind of we're trying to move a gigantic ship. And so the first steps were let's increase the expectations for disclosure, right? Let's make sure that institutions are talking about social issues, climate issues, and others within their disclosure, and let's not per se be too harsh on the details and whether we have all the detailed results and elements that we want, but over time ratchet those expectations up. And I think that is what we're starting to see. It's still in some ways early days, but more and more within the banking space, we see more and more meaningful disclosures, and the expectations each year keep growing. There's a bit of a race, if you will, between institutions on what they can disclose, and whether they can sort of outdo their peers. So from that perspective, I think that we're going in the right direction. Probably if you would have asked, 5 years ago, where would we be today? I don't know if the answer would have been all that different to where we are. If you asked 10 years ago, I think we probably are more, much farther along than you would have expected then. But so, in short, I think that continuing to ratchet up expectations, continuing to get investors and sell-side and buy-side analysts focused on this and dissecting those disclosures, we already see a number of commentaries on them that are comparing across firms and pushing them to improve the quality and the meaningfulness of those disclosures.
Thank you so much, Ilya. Annette, your thoughts?
Well, this is certainly going to continue to be a challenge as we do address, the disclosure issues, which are somewhat in a nascent stage. I think we have seen a lot of progress with TCFD. I think you've got a lot of firms looking to the SASB guidance for particular industries and finding that useful as well. But basically, I think one of the issues is there's not sort of a one size fits all either. I mean, we really want to look, and investors aren't all looking for the same things, so we really have a lot of learning to do here. I mean, this to me is somewhat reminiscent of some of the issues that we're undergoing on this task force on scaling voluntary carbon markets that I'm working on, where, I mean, there are fundamental issues and understandings that, even across the industry of people who follow these things don't necessarily agree on. What's net zero? What's carbon neutral? I mean, these are, you would think that all of this would be resolved, but we're really in a transitional stage. I found the Bilio paper very, very interesting, and I have to commend her for that. I thought it was fascinating. To me, the credit rating, or the ratings issue is even like the next step in this process, right? I mean, because I feel like I lived through the credit rating agency wars at the SEC, right, where everybody wanted credit rating agencies to be better and faster and all these other things. It's a big challenge. But first you have to get the disclosure right. Then you'd have to see whether you have focused on metrics that would be useful for some sort of a ratings process. Since the disclosure is today not in any way standardized and is quite ad hoc, it's not surprising, but it's very informative to see Professor Bilio's analysis, because it shows exactly where we are in the current state of things. So on the other hand, as we know, investors really do want to look at some sort of metrics. I mean, they want, and what we've always seen with ratings is that they provide a very easy proxy for what is it that I need to know, right? And you can't expect all investment firms to have the ability to do the kind of detailed analysis that would be ideal, right? Where if we figured out what the metrics were that they could look at, then they do the analysis. So what we're in a society where everybody wants shortcuts, everything is short and sweet. Well, that's in a sense what ratings are. And but I think we're, as the professor's paper shows, a bit far away from being where we need to be in that regard.
Thank you, Annette. And John, last word on this.
Yeah, so I mean, I think you got to distinguish between disclosure and data and how to interpret that data. And I think on the latter, different ESG ratings firms have different perspectives. And why shouldn't they? I mean, evaluating how well a company is managing its operations and its relationships with various stakeholders in terms of both corporate financial outcomes and broader societal impacts is, requires an evaluation or an assessment, of the data. And, so I think one thing that can be confusing is this impression that ESG ratings, and even calling them ratings agencies, are like credit ratings, in which different agencies are looking at the same set of data and kind of a limited set of data, generally coming to very similar conclusions. But in truth, I think ESG ratings are a lot more like, like the recommendations of equity analysts. They're marshaling all sorts of data to arrive at an assessment of a company. And so when there's a consensus on earnings estimates or on whether a stock's a buy, a sell, or a hold, that tells me one thing. And when there's a difference of opinion, that's also useful information. And so in the end, I think the proof of whether an assessment is correct comes out in performance outcomes. And I think on those, in terms of like those, the indexes that were used in the paper, which I also found very interesting, great paper. I think individually, all those indexes have performed well versus non-ESG indexes over time. But, when it comes to the underlying data and to what areas do we need to measure with data, also, I mean, we have to point out there has been, I followed this for a long time. We've worked with KLD, which is the forerunner of MSCI, and currently Morningstar has acquired Sustainalytics, so we work very closely with them now. But one of the things we've seen over time is an increased focus on materiality through the work of SASB and other standard setting organizations. And I know at Sustainalytics we construct a set of what we call material ESG indicators that are unique to each sub-industry. So there is a focus on materiality. But lately, as the field evolves, questions have arisen about even that concept, because everything's still moving. It's materiality itself can be dynamic. It's not necessarily a set thing. It could be long-term or short-term. It's increasingly also being thought of not only in terms of what ESG issues are material to a company financially, but what broader societal E&S issues anyway is a company impacting through its operations and management and products and services, and how might that broader societal impact circle back and affect a company financially. So to me, bottom line is ESG ratings can be a useful guide for assessing a company on the concept of sustainability, but they aren't always going to agree. That's not a reason necessarily to discredit them. On the contrary, it's useful information. And by the way, I think asset managers, what we're seeing asset managers doing is basically subscribing to a number of different ratings providers, and using not really the end ratings, but using the material indicators that they find the most useful for their interpretation of what is a sufficiently sustainable company, given their own, like I said in the kind of my first response, given the way that they're defining ESG or sustainability and the way that they're applying it into their strategies.
Thank you so much, John. So I'm going to give you all one more question, and then we'll go to Q&A from the audience. So if any of you do have questions, please enter them into the Q&A and I'll take a look. So I want to focus in on the theme of performance. That's come up both in the Vilio paper, but also in this discussion. And one of the areas that we've seen in the research we've done at the Center for Sustainable Business at Stern, 2 points really. One, that disclosure by itself does not result in better performance, right? And instead, really, you need to be identifying what are the key material issues that you need to focus on and embed that in your corporate strategy, and then you design your KPIs and so on around that. And when you do that, we see that there's better performance around risk, better performance around operational efficiency, around innovation and growth, and so on. But at the same time, we see all these companies sort of responding, being reactive, and also being inundated with a lot of information, some of which may not be decision useful, or a lot of information requests, some of which may not be decision useful. So how do we ensure that requests for corporate disclosure, for various metrics, focus on both material but also strategic topics, rather than kind of a laundry list of issues that companies just try to tick off, as opposed to focus on how they manage their business better. Annette, maybe we'll kick it off with you this time.
Sure. Look, I think Commissioner Lee, implored people to respond to a lot of the outreach that the SEC has done, including her March outreach with 15 questions. I think we are going to see a lot of input from the industry on what they think would be most helpful and important. Because I agree with you, a check the box approach is not going to result in either the rich data set that we're looking for or the data that would actually move companies towards better results. And that obviously from a policy perspective is where we want to be. I think the SEC's made it clear that, they're thinking about these issues both domestically, but in the context of a global economy. And the real challenge here is that we've got to figure out what is important to us, but also you've got issuers who are, operating across the globe, subject to multiple standards. So, I mean, it's heartening that what we're hearing from the SEC as well is that there is some receptivity to coming up with, in some sense, as much as possible, globally acceptable standards in this regard. It was somewhat notable that John Coates at the SEC, who runs the Division of Corporation Finance, said that he was sort of open to the IFRS approach of creating its own sustainability board. On the other hand, I heard Commissioner Lee say today, well, maybe we'll do our own thing as well, which I think is, the always the U.S. approach. But it is going to be, very important, I think, to the extent possible to do this thoughtfully, to come up with disclosures that do take us in the direction of encouraging good corporate behavior, but also doing it in a way that is as consistent internationally as possible. I think John mentioned, one of the challenges. There are many challenges with doing this, but one of them is that the materiality standards are different in the jurisdictions, and coming up with sort of a common standard on what is disclosable based on a common understanding of materiality is going to be a challenge.
Thank you, Annette. John, your thoughts?
Well, that's a great last point, Annette. I don't think anyone wants corporate disclosure just for the sake of disclosure. That's kind of what the focus on materiality is all about. But no one wants to waste companies' time or their own time on things that don't matter. And I do think, back to the question, that what ESG investing is really all about is the idea that companies, and their investors and their stakeholders will benefit from embedding sustainability into their long-term corporate strategy. But that said, there is a tension between wanting comparable information across companies and to be able to compare, and wanting companies to disclose information on those areas that are the focus of their sustainability strategy. I think as more companies move to actually doing that, and maybe the principles-based climate disclosures that we'll be considering at the SEC, this tension could be reduced between just disclosing things that somebody on the outside wants us to disclose versus disclosing information that's really relevant to the way we look at sustainability as a company. But I do want to bring up that I think this is an area where engagement is very important. Talking to companies about their ESG performance, urging them to move towards embedding sustainability into their corporate strategy. Because the more companies hear that from investors, the more they're likely to do it. And I think partly because they're also hearing this from other stakeholders. And so rather than holding that whole you know, the whole business roundtable stakeholder capitalism at arm's length and saying, you know, we'd like to do that, but it's, you know, not our shareholders will never stand for it. They're starting to get the opposite message from shareholders, that yeah, shareholders too are aligned with other stakeholders on that topic. And so, you know, engagements with companies, and I think it's really important, this important overall impact of ESG investing has to do with engagement and this idea that the investor base, the preferences of the investors in a given company are starting to change. And so these engagements are not as adversarial as they used to be by any stretch of the imagination. They're much more cooperative, and companies thinking like, oh, we need to learn from what these ESG investors are wanting us to do. And so when a company thinks it's disclosing something just for the sake of disclosing, it should engage and attempt to understand why it's being asked to disclose something. And that's actually happening. We have a person at Sustainalytics that's in charge of this whole sort of corporate response type feedback, and he's sort of inundated with these kinds of calls and discussions these days. So it feels like to me that companies themselves are more interested than ever in understanding all this and in trying to embrace this idea of sustainability and what it might mean for them, and the conversations through engagement now. You know, they used to happen very much at arm's length, and you know, through investor relations or sustainability officers. They're now way more often happening at in the C-suite or with the board. So I think it's you know, there's a lot of progress being made on that front.
Thank you, John. And before I turn to you, Ilya, let me just again encourage people to enter any questions you have for the panelists into the Q&A. Ilya, your final word.
Yeah, no, I agree with John's comments there. I think there is progress being made. I mean, I think one of the sort of causes for disclosures that aren't all that meaningful or material is in part because, you know, the companies themselves don't exactly know what to show in some cases, and they're still and you know, frankly, on the other hand as well, the investors don't always know what they want to see in all cases. And so I think the analysis needs to be done behind the scenes to understand, you know, what is material, what isn't material, and that takes time. So I think we'll get to more material disclosures over time, but it'll take that back and forth, and it'll take the work to kind of look through the set of issues, understand, you know, where they're impactful and where they're not, and filter down, right? And that's actually one of the exercises that we often do with our clients is almost like a kind of a heat map, if you will, of what should we be focused on, and let's set that up. And not everyone has gone through that or understands, you know, or has a built-in view, and so it creates for sort of unlevel results in the outcome. I think also many early disclosures were focused on the issues that are most easily addressable in the short term. And over time, as the harder points start to get tackled, then we'll see more information again in those disclosures.
Thank you so much, Ilya, and thank you so much to the three of you. So now let's see, we have a question here. Do the panelists think that a common definition of ESG will develop in the industry? If so, what will it take to get there?
Well, sorry.
Go ahead, Ilya.
Go ahead. No, you go ahead, Ilya.
I was going to go back to the point maybe from the first question about some of this is normative now. It's about what, you know, there are different definitions of ESG, right? And so, you know, some of those versions are more about values, and you know, values differ. Right. So it's unlike, in that respect, it's unlike traditional financial disclosures, if you will, because there's not a single objective endpoint that we're getting at. And so I think that issue will lead to continued differences in the landscape, right? Going back to the comparison with ratings, I think about a credit rating, you know, all the rating agencies are trying to predict the same thing. Here, we're not exactly trying to predict the same thing. So there would be continued I would expect some continued divergence. Now, the amount of divergence that we saw in Professor Bilio's paper is quite extreme, and I would expect some of that coming from just differences in defining what we're after with ESG. Some of it also is more about methodology and how you get there, and standards and things like that. And so I think those elements, as well as kind of control aspects, if you think about it that way as well. So I think some elements there should be some convergence, but because of the nature of this, I would expect there to be good cause for having differences as well across organizations.
Thank you. John, did you want to weigh in on that?
Well, I was just going to say that, I think it's best to think of it as a broad umbrella, a set of approaches that can broadly be, talked about as like sustainable investing, but it's a set of investment approaches. I think each of these approaches that are used are starting to become more systematically applied, and there's I think some agreement on the approaches. And then, as Ilya said, the outcomes, there's a range, right? Of some are going to be focused on delivering, improving investment performance. Others are going to be at least somewhat more interested in driving positive, broader ESG outcomes, or some mix of the two. And I think probably the best we could hope for is kind of a common understanding of the overall framework, of the field, or the overall kind of what comes underneath this umbrella. And that's a project I'm working on right now. So I guess that's the direction that I'd take.
Great. And I know we're about out of time. Annette, let me direct this next question to you. A significant challenge in ESG disclosures is the lack of verifiability and control. What would you recommend to deal with this issue?
Oh my goodness. A lot of hedge language in the disclosures. Look, I think that's one of the concerns that issuers have, and when they're making disclosures, is that they want to do the right thing. They want to inform investors. On the other hand, there is some lack of specificity. There's some inability to come up with hard metrics here, and so I think. Some have suggested that for a period of time, while we're sort of learning the ropes around the disclosures here, that maybe issuers and others should benefit from a safe harbor or something while we're sort of figuring these things out, because I think there is a lot of uncertainty, and I think companies do worry about their exposures. On the other hand, we've talked about mean what you say and say what you mean, but the more that the disclosure becomes expansive, it becomes more challenging. And to the other question that was raised, I mean, if the regulators are going to require greater disclosure, then they're going to have to define what it is that we're disclosing. So to that extent, one way or another, there's going to have to be a move towards a greater understanding of what is under the ESG umbrella and what is it that one has to disclose that relates to that. So I mean, at some point, we can't keep sort of kicking the can down the road. We're going to have to come up with some commonly understood, definition, I would think.
Terrific. Well, I want to thank all three of you for helping us think through some of these knotty questions. And it seems like sometimes we have more questions than answers, but we also have good, I think, direction in terms of tackling this wild west of ESG, which actually creates a great deal of opportunity for impact. So thank you. I want to turn this back over to our leader, our fearless leader here, Dick Berner. And again, a pleasure to have been on this panel with you.